Hey, Jack.
Hey Marcy, let's talk today about what is an LTV or a loan to value. So can I back up? I want to talk two things. One, from a technical perspective,
Right.
you're an underwriter.
Right.
And it's weird, you're looking at the camera and I'm talking to you. You're an underwriter. I can't help it. You're an underwriter. How do you mathematically compute an LTV? Then
Right.
let's talk a little bit about value, the mathematical formula, how you establish a value, and then how we sometimes use a value and not a purchase price. But let's first talk about loan to value. How do you do an LTV? What's the mathematical formula?
Well, I mean, for a rule of thumb, Gelt Financial sticks with 65% loan to value lenders, okay? So we will take 65% of the purchase price or 65% of the
Can I back
value.
up?
Yeah.
Okay, I want to make, so what do you, I really should have Googled this first, I'm a schmuck. But what is an LTV or a loan to value?
Versus what the value is, and we take a percentage. We want a certain amount of equity in the deal, a certain amount of equity in the property where we feel comfortable with our leverage, how we lend.
So an LTV, let me say it my idiot way, a LTV is a mathematical computation
Right.
that a lender is comfortable lending a percent of the value. So if a property is valued at 100,000, I'm just picking a number, simple number, and a lender would do, like, I think certain conventional lenders on owner occupied. We don't do owner occupied,
Right.
go up to
They'll go up to
90%.
90%.
Yeah,
Even more than that with
so
FHA,
a
right.
90% leverage or loan to value would on 100,000 would be 90,000.
Right.
So it's the amount a lender will lend you on the value. So I think with that, there's two variables. It's the LTV, which is a percent,
Right.
divided by the value of the property. So the two variables, let's break it down, okay? Is, in the example I use, it's 90%. So this is sort of where you started, Gelt usually lends 65%. I'm being honest, we want to be safe. We don't want to have a problem. We don't want to lose money.
That's just because that's our opinion of how we are safe.
Yes, well, I want to get to the value in a minute.
Yeah.
So the first part is the mathematical form, the percentage we use. So as a rule, we use 65%. But let's talk about when we make exceptions to those rules. You just sent me a deal this morning. We didn't do, but it was a 70% because the property happened to be in Florida and this and that. So sometimes we'll go higher than 65%.
Depending on the type of property and where it's located.
Yeah, we did, I forget the name, but a lady, it was a very sad story. She inherited a bunch of money. You'll remember the deal. And she bought like 4 duplexes in Orlando. And we did an 80% because we were comfortable. It was Orlando, they were rented out, and whatever. So the first thing is we generally do 65, sometimes 70%. All depends on
deal by deal.
Deal by deal.
Yeah. I don't want people out there hearing us saying, oh, I heard this, I heard not. It's basically 65%. Deal by deal, we might go a little higher.
That's correct. Or conversely, we can go lower.
Yeah. It depends.
It depends. But what really matters to the borrower is the number, not the percent, the number, what that equals.
Well, because it has to work for them.
Yeah.
You know, that's the whole point, is to make the deal work.
Yeah. So one of them, the 65% or 70% or 50% is, I remember in math, what's the numerator and denominator? You remember that in school? Oh my God, I hated school.
Now we don't even we just use a calculator.
What's a numerator and a denominator? I should know that.
The denominator's down, numerator's on top. So you divide the denominator.
So would the numerator be the 65 or the 100? The numerator would be
the value divided by our loan
So the
amount.
denominator is the 65.
Yeah.
So our denominator, I still get confused. I did terrible.
We don't want to confuse you. Bottom line is basically 65% loan to value lenders.
That's great.
Case by case. We'll go a little higher.
Now the more interesting thing is the value.
Right.
So
how do we figure out what something's worth?
So I think the industry as a whole does the value, the purchase price, or a lower of their appraised value.
Right.
So a couple things. We don't do appraisals in 99.9%. I don't think we've done
We
appraisals
do our
in the
own
past 3 years.
evaluations internally.
Yeah.
But how do we do our own evaluations? Let's talk about that.
Let's
for a
talk
couple
about
minutes.
that, Marcy. You talk about that.
So we will look at the property and see how much income it produces. We would want a rent roll with the expenses on the property to figure out what the NOI. which is the net operating income for the property. And then we'll see, you know, how much it's worth in the area. We'll look at a cap rate. What a cap rate is what the going percentage of value in that area. You know, better cities have lower cap rates, but in today's market, it's very distorted right now. What is the cap rates? What are the values? Because the rates have gone up so much that the properties have not caught up with the rates yet. I will tell you that. We have seen a lot of purchases where the borrower is overpaying for the property, because when we analyze it and we look at it, the sellers are still wanting top dollar, but the market's not calling for that anymore. So we've had to adjust our numbers to figure out really what things are worth, so we can figure out what we're willing to lend on it.
So when you see a property,
Mm-hmm.
okay, so first of all, let me back up, because people are going to be watching this who want to know what a value is for an
Absolutely.
owner-occupied home. So we do it different because we are commercial and
Right,
investment
we're commercial investors. We do not do owner-occupied houses.
So a house may be worth more to live in.
Right.
So ultimately, how a value is really what a ready, willing, and able borrower or buyer
Is
will
willing
pay
to
for a
pay.
property.
Right.
And it's common that appraisers do establish values. We don't do appraisals, so we back into it using
Right, but the reason we don't do appraisals, Jack, is because, you know, again, an appraisal is someone's opinion, and honestly, we value our opinion more than we do an appraiser's, because we've been doing this a really long time, and we can see what the market's doing and see what the type of income the property is bringing in.
You can see the gray. It'll show you
Oh, it's
how long
everywhere,
we've been
Jack.
doing it. I know.
It's
I know.
so old.
It's either gray or no hair.
So we figure it out, you know, the best to our ability, you know. We're definitely, I would say, you know, sometimes we come in more conservative because we want to protect our loan.
So a couple things. One, a value is not an exact science.
No, it's an opinion.
It's an opinion,
Mhm.
and person A may think it's worth more than person B, and it may be worth more to person A than person B. Give you an example. On an owner-occupied home, if your sister lives next door to you,
It's worth more to you.
because you want to pay,
Right,
because you
because
want to
you
live
want the
next to your
property.
sister,
Exactly.
or if your in-laws live next door, maybe it's worth less because you don't want to live next to your
Or
in-laws.
you want to live in a certain area, or you want to have a certain store in a certain area, so you're willing to pay more.
It's an opinion.
Right.
And also, you know, we're making this at a time of increasing interest rates. We're making this mid-February 23 of increasing interest rates.
Yes.
So when rates go up, values go down. So values never really stay the same. They're always a moving target.
But we have noticed in the market, though, that it hasn't caught up yet. I think the next year it's going to really catch up, where sellers are going to have to realize that their property is not worth as much as it was.
So when we
year or so
let's
ago.
say we look at a multi-tenanted property. Let's say it's a
Okay.
retail center.
Okay.
You and I just looked at a retail center in suburb of Cleveland, was it? It's closing this Friday. Literally, we just looked at it like a
Yes.
half hour ago. It's
Wow,
a,
we were
it's a little
crazy.
city outside Ohio.
Yeah, a little strip,
And
little shopping
it's
center.
4 units,
4 units.
2 are rented, 2 are vacant.
Correct.
And the guy got I don't want to go into details because
You got a really good deal
a steal
on
it.
it.
But
Yeah.
so on a property like that, how would we come up? How would we come up with value? What do we do when we see a property like that?
Well, in this particular situation, there's 4 units, and we know that only 2 are leased out and 2 are vacant. So the property is not stabilized. So right now, as of today, the value is A. But the value is going to become B in the future because the other 2 units are going to be leased out. The property will be 100% stabilized, and then the property is going to be worth more money. So we look at 2 things. We look at what it's valued now, and we look at the projection of what it's going to be valued in the future. And depending on the borrower's needs, we'll adjust the loan amount. If we feel comfortable, we may do more than 65% on that type of deal if it demands it, or we'll stick at 65% because you know that they're paying higher rates with us because our rates are not bank rates. But we do know that the borrower will be successful because he's going to stabilize the property and he's going to refinance us out into a traditional commercial loan, which the rate will be better. And then there you go. There's his NOI and there's his successful story.
So on stabilized properties,
Mhm.
what we do is we take the gross income,
Right,
we minus the expenses,
and we come in NOI.
and
Net
NOI,
operating income.
net operating income, good,
Mhm.
thank you, and then we use a cap rate. So
Right.
to a certain degree, we can plug in any of those numbers. So if you bring us literally any type of property throughout anywhere in the US without a rent roll, without any financial
We
information.
can figure out the value.
Yes, because we have enough experience. We look at so many deals, hundreds and hundreds of deals, probably 500-600 deals a month.
I can't
So
even tell you
how many?
deals
So
I
what
go through a
happens
day.
is we can plug in a number and say, okay, we think that market is 15. I'm just going to use a retail center, $15 a foot,
Right.
and we think the expense load is roughly 40%. So
And we're conservative.
Yeah.
You know, we're gonna go
But
with the lower number.
we'll come up with a value.
Yeah.
And advice to real estate investors is you need to learn and I always talk about learn your craft and don't be I don't
No,
know,
because you need to learn to look at it from all different angles,
well,
Jack.
and
That's why we tell this to the brokers and
sellers
borrowers.
don't present all the
truth.
factual
So
information.
you gotta do your own research.
Marcy said it more apropos.
Yes.
I said all the factual information.
Yes,
She
the
said the
truth.
truth. So you need to
No.
be able to, if you're a buyer or an investor, you need to be able to look through things.
And when we say look through things, it's really kind of simple. We get all our information from the internet, as anyone can. See what the going, rent rates are. See what's selling per square footage. Do your own research. Do not just take the explanation of your realtor or broker.
Quite
Find
often,
out, they don't give you the
yeah,
whole picture.
it happens all the time. You know,
Yeah.
I don't want to say every day of the week. I'm exaggerating, but constantly we close a deal. We warn buyers.
Mhm.
And be careful because you didn't get all the information. We think the expenses are more. We think the income's lower. And inevitably they call us up a month or two later, oh, you were right, I should have
Yeah.
listened to you.
But
either
we
way.
help them and they figure it
Yes,
out
yes.
and we go
So
forward.
you want to come up with the gross income.
Right.
You want to come up with a realistic expenses, but you have to be careful with expenses. For example, certain geographic locations, they reassess the taxes
Right.
based on a sale, so you have to plug those in. If a seller's giving you expenses that don't have the appropriate tenant improvement, leasing commissions,
You have to take all that
CapEx,
into
you have to
consideration.
come up with what
Yeah.
you think is the real expenses. You'll come up with a net, you'll put an appropriate cap rate on there,
Yeah.
and you'll come up with a value. And again, it's all an estimate. There's no exact science, but it's
Well,
an
as I
estimate.
always say, and I'm going to say it again, it's an opinion.
It's an opinion.
Yeah.
Now, what do we do on, let's say it's 10 stores and 5, the deal we did today. 2 are occupied, 2 are vacant.
We're going to take a pro forma. We're going to ask,
Tell everyone, maybe some people don't know what a
a
performer
pro
is.
forma
I gotta
is
take a
what's
drink.
going to,
My
is,
throat gets so dry all the
Look.
time.
a pro forma is, in a sense, a rent roll, but what's going to be in the future, what it's going to perform in the future. So take that into consideration, like in this situation, it was 4 units, we know 2 are vacant. Well, what could those 2 units potentially rent for? So we'll plug those numbers in with the expenses and then go from
Can I
there.
ask a question?
Yes,
Yeah,
you can.
that's a new thing in the office. Michael raises his hands at meetings.
I still do.
Very
I'll
polite.
burst in, go
He's
ahead.
a very polite guy.
I'm not polite, but I have,
No, I know.
I
I know.
want to talk.
So a couple things.
Mm-hmm.
So you can, like the units that we looked at this morning, they were
Right.
maybe 1,000, 1,500 square feet.
Yeah.
So when you come up with, you look at your comps,
Mm-hmm.
you see how much they're going to rent for. So let's say the rent's $10 plus cams or
Right.
$15 gross or whatever the rent is. You'll see, but you also have to guess, and it's a guess, how long they're going to be vacant for. So give an example.
Until you're gonna rent them out,
Yeah.
and if they need any build outs or
Tenant
any
improvements.
tenant improvements, it's not as simple as sometimes borrowers think.
Well, one of the
know?
reasons we like to do deals in urban and suburban areas as opposed
Right.
to rural is because
you can have people that go
it's
through it.
densely populated
Yeah.
as well. We don't do specialized properties. We don't know how to rent them. So we at Gelt like properties, whether it be an apartment or a flex building or a self-storage,
mixed use.
mixed use,
Yeah.
that is easy to rent out, that you can call up a local realtor and within 30, 60, 90 days, it's rented out.
Right.
And the truth is, if you're looking at like a 5-unit building in a densely populated area, we do a ton in like Brooklyn, New York,
Right.
tons.
You're gonna get it rented
You know,
out.
whether it's rented out to Sally, Mike, Tom, Dick, and Harry, the tenant name doesn't matter, because if it becomes vacant, you'll rent it to somebody else. So you have to build in your projections. I did it, I don't know if you were part of it, but I remember I did one on how to build projections and debt service yields and a spreadsheet and how to put it together. It's really a good one to watch, because when you do
I
that,
definitely did not do that. That's too technical for me.
I had one day like 6
You were
years
like
ago.
in a technical
yeah,
mind?
it's not my thing, but
Okay.
no, actually I like spreadsheets. I really love spreadsheets.
He does like spreadsheets.
Because I like projections, it's
Yeah.
kind of interesting. But what you do is you sort of handicap and say, okay, I'll be able to get this much rent. How sure am I of it? How much am I going to have to spend in tenant fit out and leasing commissions, things of that nature?
Right.
And
And
how
you'll
long
see-
it'll be
you'll
vacant
see,
for.
Right, and then you'll see what your numbers look like.
Yeah, so on performa properties that aren't stabilized value add, we take a performa.
Right.
Again, and I have to warn borrowers, and again, I feel bad always doing it. You know, I don't want it to come off where I'm lecturing or preachy or a little obnoxious.
And also, like, now to, in a sense, not to trust people, because
That's
you know,
exactly
some
what I was
people,
going to say.
yeah, because most people, you know, they're going to tell you the whole story, but then there's
They
that
tell you
pocket.
what they want you to
Of
hear.
course, I mean that's with anything.
Yeah, they don't.
You know, like when you first start dating someone, everyone's like on their best behavior because they want.
I told Marcia I was a nice guy. I have a good sense of humor.
As I'm here
patient.
6 years later, oh
Yeah.
my
Yeah.
God.
Oh, I lied to you, basically. I lied to you.
Well, I guess you grew on me.
Yeah, whatever. Anyway,
You know, so you just have to kind of play it out. You have to play it out.
but be cautious with what they tell you, whether it be a realtor, nothing against realtors, or nothing
No.
against sellers, but they tell you what they want you to believe.
So do your own research.
And don't believe anything they tell you. You know, you speak.
I mean, that's not in a bad way. That's in a way like be an investigator. You need to investigate and look for the facts.
Because at the end of the day, when the poo-poo hits the fan,
It's
they're going to be
you.
gone. The
Right.
realtor's making a commission on you. The seller wants his money.
Yeah.
You know, the seller's always going to say, "Oh, it's always vacant. There's no management. There's no tenant improvement. There's no leasing commissions. There's no this. There's no that." They're full of it. There's always much more expenses. So in your performa,
You gotta
build
put that in
in
there.
a lot more expenses, because even if it's 100% occupied now, I guarantee the day you buy it, there's going to be a problem.
Air brakes. You need to do something. You need to shovel snow. You need to do this. You do that. It's like
Always
it's
happens.
unbelievable.
So again,
There's a leak.
there's a leak.
Could be plumbing issues. I mean, there's just
It just
it's
happens when I
life.
get old, Marcy. I
It's
can't
life.
help it. I'm 60 years old. I have plumbing issues.
He's so
What
old.
can I tell you? I'm almost 61, actually.
Oh my God.
Anyway, where the heck were we?
We're talking about
so
performa, like-
performance. So at the
Yeah.
end of the day, you want to come up with a number that's the projected or stabilized NOI.
Mm-hmm.
You have to put a realistic cap on it and just do the math, and it'll come up with a value.
And that's the value.
Yeah. So sometimes, so at the end of the day, you're going to come up with value. So we have two things. We have usually our 65%,
Right.
which is a general
And
rule of thumb.
it's pretty much a good rule of thumb.
90%.
Yeah.
99%.
Absolutely. It's
Yeah.
just the way
Yeah.
we look at it.
But what's more subjective is what the value is. The
Yeah.
property could be worth 800 grand, could be worth 9, a million, $1,000,001. And
Yeah.
look, I'd love to tell you.
Because then I will tell you also, because of that issue, like we do have a lot of brokers or seller, come to us or borrowers thinking that their property's worth this value. And then I come back to them and I'll say, well, we don't think it's worth that value. We think it's worth B value. And the property can only handle C loan amount. So, they come to me with a request, but then once I crack down the numbers and look at it from different angles, I will let you know what the property can carry in a loan amount. That's another thing. Even though the property may be worth $600,000 and we're telling you that we'll do 65%, but then when I get that loan amount, the property cannot carry that loan amount. They can't they can't make the payment because the rents haven't caught up with the value, whatever the case may be. That happens a lot actually in Brooklyn, in New York. That happens a lot. The properties are worth more than what they're getting in rent. So that's another thing that we will sometimes not do 65%. We'll do whatever the property can carry in a loan payment.
Yeah, so look, I'd like to tell people that we get it exactly right 100% of the time.
No, we do our best.
We do our best,
Yes.
and that's all anyone could do.
Mm-hmm.
You know, we try to come up with a value, we divide it and come up with 65% of that, and that's usually what we'll lend. Sometimes there are exceptions to it. You know, we base our value on what we call the value, not the purchase price. So give you an example, there's something called ARV, after repair value.
Right.
So let's say, let's just stick with Brooklyn only because we talk
Yeah.
about it, but we do
We
loans.
do a lot in Brooklyn.
But we do loans all over
All
the
over,
place too.
but yeah.
I'm going to go on from Brooklyn only because there was a deal we did. I forget the lady's name. She was so nice and so thankful. I think it was Birmingham. I forget. She bought a property. It was a single family home. She bought it very cheaply. Let's say 80 grand, and let's say my numbers may be off. I forget. Let's say she needed 50 to fix it up. So she's in for 130, but she thought it would be valued at 250 after it was completed. So if she's buying a property for 80, she's putting 50 in, she thinks it's going to be worth 250 or 230 after it's completed. What the heck do you do your loan to value on? Then
Right.
you do the ARV. So let's just use a number of 250 for a round number. If we really believe that, okay, we will do our loan to value on that 250 number.
Right.
In this particular case,
she
owned other real estate.
Yes. And there was also rehab money. Yeah.
So if I remember correctly, and this goes on all the time, at closing, we'll lend them the 80 grand for the purchase price.
And then hold back the money for the rehab, and then disperse it as the work is done.
That's correct. Let's say it's 50,000. Maybe at closing, we'll give her 10,000 for the work. Once it's done, you know, as the work's done, we'll advance it on a draw schedule. Right. So they in those cases where it's a value add deal, use what's called an after repair value or an ARV. Yeah. Which sometimes gets a little confusing. Now, another thing, I don't want to confuse everyone, what we do a lot of here, or a good amount, are blanket loans.
Which we've had videos on just blanket loans to explain them. So blanket loan is when we take several properties and put a lien on all of them to get more equity for us.
So if a person, give you an example, if a person's buying a property for 250 grand,
right.
And it's possible for us to lend them 250 grand. If they own other property
where the equity is coming from there,
yes,
to buy that purchase, and we've done deals like that.
A lot of our deals have other collateral. So a lot of times, a borrower will come in, and in their eyes, they're getting 100% loan to value. Because we are lending them 100%
on the purchase.
On the purchase.
Yeah.
In our eyes, we're getting a 50 LTV deal because there's other collateral.
Right.
So there's a lot of, now, not on every deal. I know sometimes when we talk about 100% LTV, it's very.
We don't do 100% financing
on
only if there's blanket and there's equity in other properties.
Or the property they're buying is significantly undervalued.
Right. Depending on the situation, like we did do a deal once where it was a lease option to purchase. So they had been in a contract for a while, and now it had come to the point where it was time to purchase the property. And the purchase price that they had on the deal, the property had gone up so much in value that we lent them 100% of the purchase price. To buy.
So we're at Gelt because we're not selling our loans on the secondary market.
Yeah.
She makes the decisions. She lets me once in a while.
We do it together.
We'll base our
loan to value, really.
I was going to say when a girl says to a guy, I'm going to get in trouble.
Are we in joke mode right now?
No, it's not a joke. When a girl, we do it together. We decide together. That's not true. The women always decide.
Sometimes I try to sway your decision, but you make a decision sometimes, there's no swaying you.
Really?
Yeah.
Easily swayed. No. Anyway, we base our value on what we perceive the real value is,
Right.
not necessarily the purchase price.
Mhm.
So if you're buying something at an auction, another deal, he was a repeat borrower. He bought a warehouse property. It was the suburb. It was like right outside the airport in Chicago.
He got a great
A
deal on it.
steal.
And we gave him all the money.
100%.
It was worth so much more than
Yeah,
he
and he
paid.
sold it for us. So
Yeah.
bottom line is, it's not so easy. There's a lot of variables when you figure loan to value.
But the bottom line is that Jack and I have the experience to figure out how to make the deal work. That's all I can tell you.
Okay,
That's the truth.
do we give the listener a good
I
idea
think
of loan
so.
to value?
Yeah, I think that they had like all their questions answered, and of course, any questions you have, please just send us a little note and we'll answer them.
We answered, that's correct.
Yeah.
Yep, we're gonna post this on YouTube. I'm supposed to tell people in the beginning. I always forget. Like the YouTube channel.
You know why we say in the beginning? Because they may not get through the end.
Yeah, sometimes I don't even get through the end. Like the YouTube channel, like the video, leave us your comments and questions, we'll answer them. And if you have any more ideas for videos, let us know.
We love to talk, and we're so much information in our brains.
I don't really like to talk.
I do.
Yeah, if it was me, I would sit on the sofa and just never talk. I'm fine with that.
You like to talk on this.
I don't like to
Because
talk.
you love to talk about what you do. You
I love
it.
the business.
Yes.
I'm passionate about the business.
Yes, you are.
And I do like to talk about it, but
Yeah.
generally, I'm not a talker. I like to sit and
Yeah,
be left
we've
alone.
gone to lunch and he doesn't talk the
I
whole
don't
time.
talk. I'm better off sitting on the sofa, watching Netflix, no interaction with human.
I get
Fine.
it. I get it.
Anyway,
that's it.
that's it.
Have a great day.
Have a great day. And remember, when your
Season.
bank says no, we say yes. Take care.
Bye.